Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, and I have Russell Rhoads on the line. He's a senior instructor with the Options Institute at the Chicago Board of Options Exchange. Russell, how's the year treating you so far?
So far, so good. Treating me better than the market seems to be treating some people taking a look at the S&P futures right now.
Okay, was taking a look at your blog, and you did a nice write up there on the VIX. First of all, could you explain the VIX to our listeners and the implications from it?
Oh, absolutely. I think explaining VIX is what keeps me employed here at the Options Institute because it's a big area of focus for me. But basically, VIX it's an index much like the S&P 500, but the inputs into VIX is pricing from S&P 500 index options. We take two different S&P 500 index option series, and we determine the implied volatility from all the actively traded out-of-the-money option contracts, which usually comes to somewhere between 100 and 200, depending on how active the market is. And through a pretty complex formula, we actually come up with a consistent 30-day implied volatility as indicated by S&P 500 index option contracts. So at this in about 10 minutes when the market opens and we've got SPX option quotes, if we had an option that expired 30 days from this very moment or from that very moment, the implied volatility of that, and it's an at-the-money option contract, the implied volatility of that option could be what we see as being quoted as VIX. So it's just a consistent measure of implied volatility based on S&P 500 index option prices.
Okay, so going back a little bit here, through 2004 through 2007, you had a series of gains, in the markets, very good, considerably good gains, and kind of, also, increases, in the percentage ranges here. After those percentage increases, you had a big drop in 2008, good years in 9 and 10, a pause in 11, then three strong years. Just according to the VIX, I mean, are we setting ourselves up for a little bit of a weak year here?
I'm going to come across as an economist here because
no.
I'm going to give you arguments both ways. If you and actually I've got a chart of VIX going back to 1990, and the cycle that you just mentioned, it basically repeats some things that went on in the 90s as well, where we had a couple of 2 or 3 fairly calm years, and then things got pretty hectic in the market, and then things calmed back down, and it took a while for things to calm back down. 2014, it looks like the end of relative calm for VIX. If the pattern continues to repeat itself. But one of the interesting things is you're starting to hear people talk about years that end in the number 5. And 1995 and 2005 were two of the calmest years for VIX. So the cycle of the chart, if you don't look at the years, looks like we're in store for a pretty volatile year in 2015, based on the history of the stock market in years that end in 5 and what VIX has done for the couple of years that end in 5 that we have numbers for. You could take the other side of the argument.
And you've had some nice increase in the options volume, and also the futures volume in VIX has been steadily increasing. Do you expect that trend to continue in 2015?
Oh, absolutely. We've seen at CBOE, we've seen increases in VIX option and futures volume in a low volatility environment. But when we get record volume days, and I can't remember the exact date, but the record volume day for VIX options and VIX futures was back in October this year, when we had a pretty big increase in volatility. That's what usually gets people interested in VIX. They hear that the market's down 1 or 2% and VIX is up 20%, and in the back of their mind they know that you have the ability to buy call options on VIX, and then they start taking a look at that market. But our volume growth has come in a couple of relatively calm years, and so the first big spike in growth was in 2008 and in 2009. So an increase in volatility actually would result in volume growth. Without an increase in volatility, we've been getting pretty good volume growth as well.
And what would you say to the investor that's like, man, these things are just decaying instruments. The price is always going to go lower. Every time it stops and pauses and then just has a pop up, I'm going to just short it because there's just no way it's going to be sustained. What kind of advice would you have for someone that wants to? I mean, because really the only time they got burnt was in 2008. It's been, you can look at the spike of volatility in October off the Ebola, 2 days up there, came right back in. Then it just sat between 12 and a half and 14 and change, sat there, pop up again in December to 25 and change, right back down. What would you say about someone who wants to employ that strategy?
Well, the strategy, you're on the right track there. In fact, we have little sayings around in the financial industry, and one with respect to volatility is that professionals sell volatility, and nobody's allowed to take offense here, but retail traders tend to buy volatility. But I think the retail trader is getting, now that we have VIX and people can see how volatility reacts in a very plain way, they've been attracted to taking the other side of those spikes. I think that's a great strategy, but be aware that VIX can go up 50% in a single day. We had VIX in 2011 go from 32.00 to 48.00 in a 16-point move in a single day, and we'd already moved up to the 30s. So if somebody had come in and tried to take the other side of that move with the anticipation that we're going to go back down and did not manage their risk somehow, they're opening themselves up to an awful lot of exposure. I tend to encourage anybody that wants to take the other side of a move up in VIX to consider selling a call spread, so you have your risk defined, because we have had 2 and 3 leg moves up to the moves higher in volatility in the past, and they'll happen again. And fading volatility moves, it's a good strategy, but make sure that you control your risk when you do something like that.
Yeah, that's always a good point. So if you talk about hedging your portfolio, there's something that you want to do. A lot of different strategies out there. The futures markets, the options markets. Is the VIX and the VIX options, is that really the best way to hedge a big portfolio?
If I were a company man, and I try not to be fully a company man because I think it messes up your credibility sometimes, but if you're a company man, I'd say of course. But it really does depend, and it depends on where VIX is and what kind of how much risk is already priced into the market. There are times, and let's just say you're a plain vanilla long equity portfolio manager, sometimes the better way to hedge yourself might be through SPX or SPY put options. Other times it might be buying call options on VIX. And and this is one that we had not seen until December, but anybody that kind of pays attention to VIX knows that there was a huge put buyer in the market in early December, and the feeling was that buyer of put options, VIX put options, might have been short the S&P 500, and they were worried about a move to the upside that would have taken VIX to the downside. And that was the first time we saw VIX options being used to possibly hedge against a spike in the S&P 500. We'd never really thought of it from that standpoint before.
That's interesting, and also just moving on. What are some of the event? I mean, it's always hard to identify the exact catalyst which is gonna disrupt the market or send volatility much higher. Just to close things out here, what should investors be looking at in 2015 for something that might be a catalyst to really send this VIX into orbit?
Well, it's something that's coming up probably starting about next week. When we get off the phone, I'm going to start looking at the earnings calendar. But, 2014 year-end earnings, where you get forward-looking statements out of companies to 2015, might be, might not be the most positive thing for the S&P 500. We're already kind of at a high end as far as valuation goes. And the other thing is when companies file their year-end reports, they have to be a little bit more meticulous than when they file their quarterly reports. So you might maybe the next 2 or 3 weeks might be the first treacherous thing for the S&P 500 that might result in VIX moving higher as well.
So you're going to the solid old fundamentals and the earnings of companies is something that may be the next catalyst for more volatility in the market. We've been on the line with Russell Rhoads. He's a senior instructor with the Options Institute of the Chicago Board of Options Exchange, joining us here on Benzinga's pre-market prep for talk about VIX and the CBOE in general. Russell, thanks for joining us. We hope to have you on again soon.
Okay, thanks a lot. Appreciate it.